Hey everyone, this is Dwayne and welcome to Revo Academy. So after understanding about the difference between the reduced rate and also the flat rate, today we will be talking more in depth about how does the housing loan work. First and foremost, we want to talk about the loan tenure. So in terms of housing loan, the maximum loan tenure is up to 35 years or an age limit of 70 years old. Yes, that's right. So if you are actually currently 50 years old, the maximum loan tenure is only 20 years. Thus, your repayment would be much higher compared to a 35 years loan tenure. So it is always advisable that to take the loan as early as possible so that you actually have a lower repayment in terms of your monthly your mortgage loans, and also it will increase the chances of getting the loan approval. The second thing that we want to talk about is the interest rate of housing loan. So interest rate is actually established or governed by the Bank Negara, and they use this thing called OPR, overnight policy rate, to actually controls the interest rate. However, different banks have their own different interest rate based on their base rate. Based on 2015, there's a new framework where this implementation of replacement of BLR, base lending rate, to base rate, where actually base rate would give a better transparency for the borrowers to make a financial decision on which bank to choose. For example, Maybank, their base rate is 1.75% and their margin interest rate is at 1.5%. Their effective lending rate is 3.25%. And on the other side, let's say we have Public Bank, which at 2.27% base rate, plus the margin interest rate at 0.83% is equivalent to 3.1%. So normally the bankers will only tell you the final interest rate, which is the effective lending rate. So for Maybank it would be 3.25% and for Public Bank is at 3.1%. But it is also very important to understand the base rate of the bank that is offering, because the base rate will actually determine how efficient is this bank in terms of running their operation and also lending to the borrowers as well. So the lower the base rate, the lower is their cost, shows more efficiency in that particular bank. So next we want to talk about the margin of finance. Basically, how much percentage in terms of the property value the bank is willing to loan you. So in Malaysia, as a standard guideline is that for everyone, they can actually own up a housing loan up to 2 property, up to 90% loan. And then the third property would be capped at 70% loan. However, if you're looking to buy a commercial property such as a shop lot, then the loan can actually go up to 85% and there is no restriction of the quota. So if you are buying a commercial property, you can buy as many as you want and you can still get up to 85% loan. However, sometimes due to the valuation of the property, the bank has the right to actually not offer the full margin of finance, let's say 90%, but we're only willing to offer the margin of finance based on the bank valuation. Please take note that when it comes to margin of finance, the bank is willing to lend. It also very much depends on the valuation of the property. So the bank always has the right to actually offer not the maximum amount of margin of finance, but will actually based on the actual bank valuation of the property. So it might not be 90%, it might be offering lower than 90%, 80% or 70%. Whenever you buy the property, please do check on the bank valuation before you commit down into the booking or the deposit payment. So we talk about the loan tenure, we talk about the interest rate, and we talk about the margin of finance. And last but not least, if it comes to housing loan, you want to know about what are the housing loan account that is available in the market. So we have 3 types of housing loan in Malaysia. First of all, we have the basic term loan. A basic term loan is one that comes with a fixed repayment schedule where the monthly repayment you pay is the same throughout your entire loan period, right? So it's a very conventional loan account, and generally as of now many banks do not offer such an account anymore, but there is still a few that offers such account. And moving on, next we also have the SemiFlexi account. So a SemiFlexi housing loan is a type of home loan that actually have an inbuilt facility that enable borrowers to make at once payment to their loan to lower down their interest without the need to make any formal request to the bank, right? However, for a SemiFlexi account, you will still need to go through some certain procedures like making an application and submitting an application if you intend to withdraw the money out, right? But this is also already a very convenient approach where you can actually, when you do have extra capital, you can put in more capital into your loan account to reduce down the interest that you are paying for the loan. Last but not least, we also have the FullFlexi account. Allows the person to make a flexible payment and advance payment to lower their property interest and withdraw the additional payment made whenever they like. And the difference between the FullFlexi and the SemiFlexi is that FullFlexi, they're actually linked with a current account, and normally they also issue you a checkbook as well. This will allow you more flexibility to actually withdraw and also deposit your advance payment or your cash out from the account. However, for the FullFlexi account, you will probably need to pay annual payment for having such a service. So these are the 3 basic housing loan accounts that you should know in Malaysia. So this is the end of the session for how does the housing loan work. If you want to find out more about how the whole entire process of housing loan work, check out our next video for Revo Academy.